Thank you everyone for joining us this afternoon. I'm Nikki Jovicic from LookUpStrata. Welcome to today's webinar, What's the Purpose of My Reserve Fund's 10-Year Plan? We're joined today by Kaylene Arkcoll from Leary Partners. A copy of the recording of this webinar and the associated slide pack will be available in the December edition of the WA Strata magazine, which is due out on the 12th of December. If you're not yet a subscriber, I will include a link to our subscriber page in the chat in a short while. And if you are already a subscriber, just be sure you've indicated your preferences for WA content so you receive the magazine and any other information we have from time to time, specifically concerning WA. I'd like to say hello to all of those lot owners and professionals who chatted with us at the recent SCA WA convention a few weeks ago. It was lovely to meet you or to see you again. Hopefully you've had a chance to either pick up or download one of our WA 10-year maintenance plan checklists. This checklist was created in consultation with Kaylene. If you do not as yet have a copy, I'll also be sharing a link to this resource in the chat in a few minutes' time. Before we begin, I'd like to mention that the information contained in this session, including the discussions that arise from submitted questions, is not legal advice and should not be relied upon as legal advice. You should seek independent advice before acting on information contained within this session. During the presentation, I'll be moderating the chat, so be sure to say hi. Thank you to everyone who submitted questions before this event. We will also be collecting questions during the session and we will get to as many of these as possible. Otherwise, we will get back to you at a later date with a response. If you would like to participate in the chat, we welcome you to do that. Just click the drop down directly above your comment and select the option All Panelists and Attendees, and that way everyone can see your comments. During the chat, before we hopped into the session, there was a small lag with the feed at Kaylene's end. We apologise for any issues we may have, but hopefully this will be okay. Okay, I'm very mindful of the time and also we have a lot to cover, so here we go. I'm delighted to introduce Kaylene Arkcoll. Kaylene is Head of Legislative Services and co-owner of Leary Partners. She holds a Bachelor of Quantity Surveying, Masters of Applied Law, Taxation Law, and is a registered tax agent. In 1990, Kaylene was one of the Leary Partners quantity surveyors who prepared the company and Australia's first Strata industry sinking fund forecast. Since then, Kaylene has been part of the government consulting group for the equivalent reserve fund legislation in Queensland, New South Wales and Victoria. She has prepared and supervised the preparation of many thousand 10-year plans across Australia and acts as an expert witness in disputes which involve assessment of administrative and reserve fund expenses. Equally important, she has extensive experience working with the reserve funds and 10-year plans as a lot owner and a lot representative, all of which gives her insight into the various issues we are likely to experience as we roll the mandatory reserve fund legislation out here in WA. Welcome, Kaylene, and I'll hand it over to you now.
Thank you very much, Nikki. And yes, I do apologise. I'll trust Nikki to yell if the connection gets too bad. The NBN does not like us in our area at the moment. So I'm just going to share my screen here. So Nikki's already sent me through a number of questions, which were quite interesting, very wide-ranging, and I've incorporated a number of them into our presentation this afternoon. If we get time, we'll try and address some more of them. If we don't get to all of them, or if some of them are a little too specific, let Nikki know. We'll try and answer them later. Since the amendments came into force in around May, I've answered a lot of questions about reserve funds and in particular about reserve fund 10-year plans. And almost all of them boil down to three core questions. What is its purpose? What should it contain? And after you've got it normally, how do I use it? So my objective today is to give you an overview of the relevant legislation. with as much practical feedback as I can try and fit into a 60-minute time slot. There is a lot more advice I wish I could give you. So if we get to a point where we're talking about something and I have to move on, give Nikki a note. I'm happy to give extra information in articles or webinars, or have a forum where you can ask direct questions in more detail later on. Most of the questions I'm currently fielding about 10-year plans seem to be the result of people reading section 77 of the regulations in isolation and not considering how that whole 10-year plan fits into the overall regulatory scheme. So today we're going to start from the top with the Act and work our way down through to the regulations. Now, the main systemic change we're going to look at is that we now have a new class of strata companies, designated strata companies. And if you are a designated strata company, then you now have a mandatory reserve fund, and you also have a mandatory 10-year plan. If you aren't a designated strata company, not a lot has changed. You still have the option of electing to use a reserve fund. And if you opt into that reserve fund system, you then have the second option about whether you want to use a 10-year plan. Now, some of you have asked what I thought was a reasonably simple question till I stopped to think about it. How do I work out if I live in a designated strata company? So here it is, section 107. This is the test. If you live in a strata company with 10 or more schemes, you are automatically a designated strata company. If you have less lots, you need to go to regulation 79 and you need to pull out your latest replacement insurance valuation. Because if you have a building replacement cost in total for a strata scheme that is greater than $5 million, then you are also a designated strata company. If you are a survey strata scheme, you need to make sure that your insurance value that you're looking at is only for the component of the valuation that is common property. So the common property component needs to be over $5 million if you are to be a designated strata scheme. Question 2, is this a one-time test? No. There will be a small group, probably of commercial buildings, who will have an amalgamation of a lot or a subdivision of a lot, which will change that designated status. There will also be a slightly bigger group of strata schemes who have a building replacement cost that is sitting just below that $5 million level. And over time, the cost increases could push you over the threshold. If you're managing one of those schemes that is just under the threshold, I suggest put a file note on your insurance valuation so that next time you get the update, you automatically have a reminder to check where that threshold is compared to your new valuation. Assuming that we're now talking only about designated strata schemes, we're going to start with the section 100, which is the general operation of the reserve fund. This wording has been renumbered, but it is largely the same as it was in the old Act, which means A, it's not written in simple English. B, it contains important concepts like contingent expenses or routine nature, which aren't defined in the legislation. And C, it requires the reader to understand and apply some very technical concepts. Put simply, for most lot owners, this is not user-friendly legislation. We don't have the time to unpack all of the potential issues around that wording today. That is a webinar all on its own, and there are some really big landmines if you're not sure what you're looking at, particularly now that it is mandatory that we work out which things come from an administrative fund and which things owners have to put away money for way in advance and which may be happening well after they've sold out of the unit. But there are 4 critical things we need to talk about just because they affect our 10-year plan. 1, obvious. We have to have an agreement about which expenses come out of the administrative fund and which of them come out of the reserve fund. Then equally obvious, we need to make sure that our reserve fund 10-year plan is consistent with that budgeting. That sounds easy. In practice, it's not always. So to give you one of the classic examples, if you have a building that has a maintenance contract to maintain your fire protection systems or a maintenance contract to maintain a lift, part of that contract cover is probably for your annual administrative routine, preventative maintenance, general testing, admin territory. Part of the contract is also probably for replacing individual components like smoke detectors and fire extinguishers if those items fail the test, or in the case of a lift, to do the repair for basic repairs and to replace some of the components, both of which are not routine work and which technically should be coming out of your reserve fund. In practice, most managers are likely to take the easy option and you will put all of that cost in your administrative fund. But if you do that, when I as a consultant come to put together your 10-year plan, it's really important that I know what you're doing so that I don't duplicate those expenses in that 10-year plan levy, or alternatively, if you are not funding from the administrative fund, that I don't leave a big gap because I assumed that you have. Third point is interesting. You may or may not have to worry about what I call the foreseeable or the reasonably foreseeable principle. We go back to our definition here, that one of the terms is contingent expense, not defined in the Act, but a general dictionary definition would say that the reserve fund is intended to pay for expenses which we expect the strata company to incur when certain events happen in the future, so that there is a concept of reasonable expectation for it to be contingent. And the same concept down there in the bottom line, major expenses of the strata company likely to arise in the future. Here in the eastern states, we now have established precedent that says for mandatory funds, it is not appropriate to be levying and to be accumulating unattributable cash amounts. So what I'd call contingency or just in case buffers. That means if I'm putting together an eastern state 10-year plan, I don't have an allowance in there for something like concrete cancer, unless I have a history of concrete cancer at your building, or unless when I'm working around the site to do the inspection, I see some early signs to suggest concrete cancer is likely to be developing. So you need to be mindful about what you are actually expecting to be putting into the fund, and be aware that if one of these major big contingency expenses does happen, the fund may not have been designed to cover all of that expense. You could still be exposed to some forms of special levy. And this last one is even more potentially explosive. Once you get to about 5 to 10 years into your plan and have got a nice big reserve, you need to consider when it is appropriate to use money from the reserve fund that has been collected for a specific purpose in that 10-year plan to repurpose and use it for a discretionary project, for that major new upgrade of infrastructure that wasn't part of the plan, for that big refurbishment. And we saw in Queensland in particular, it got to about 5 years in and all of the investment owners suddenly looked at their investment property and said, wow, look at all that money. Imagine what I could do with that money. I'm not going to be here when the painting needs to be done in 4 or 5 years' time. and they basically raided the expenses and then left the later owners with a big pull down. So yes, there's a policy there, but in particular for our 10-year plan, we need to work out when it's appropriate to put those expenses into the 10-year plan. So am I authorised to start collecting levies through the 10-year plan if the owners haven't actually authorised that project? And the answer is probably no. This may be one of those cases where you will be better off running the 10-year plan and having a separate funding mechanism in parallel for your extra costs for that project, where you can control specifically just those project costs. Now, Nikki, you're going to have to give me a time check when we're about 10 minutes out, because I've restarted and that means my clock has got reset.
Okay, that's
now, starting from our reserve fund legislation at the top, this is the legislation section that actually sets the fact that we have a reserve budget, and it doesn't change. The 10-year plan does not override your standard budget process. You still have to sit there every year and decide what expenditure you're going to have for that year. You still send it to an AGM for approval, and only when you've got the AGM approval can you actually do the work. So if you ring me up as a lot owner and tell me, you did a reserve fund for me 4 years ago, and your reserve fund says that I should have a budget for $2,000 to repair my fence. The committee just put the AGM budget together and it doesn't include the fence repair. What should I do? My first question is going to be obvious. Does your fence actually need repairing? So your budget each year here uses the 10-year plan as a guide. So when you set your budget each year, pick the 10-year plan up, look at the items listed in that 10-year plan and ask the basic question, do we need to do those yet? If the answer is yes, it goes in your budget plan. If the answer is no, you make a note that you need to look at that again possibly next year because it may have become necessary then. The purposes of this 10-year plan is not to create an absolute maintenance timeline that you must follow. The idea is that we are estimating when the funds may be needed and making sure that they're there ready for you when you do need to spend them from the budget. And we stop and we redo this report every 10 years to make sure that the theoretic expenditure doesn't get too out of sync with what you have actually been doing and your actual maintenance time frame. The last thing that we need to look at in our top legislative level is the levies. Now, setting the levies for an administrative fund is easy. You set your budget, and once you've set your budget, you know how much money you have to raise to pay for those expenses. For the reserve fund, there isn't a direct relationship between your annual budget and your actual annual levies, which confuses a lot of new users. Instead, the reserve fund levy has to take into account both the cost of your approved expenditure for this year and the identified future year's expenditure. So when we calculate the reserve fund levy for this year, we need to identify both the current expenditure from our current budget and our future outgoings, and then we calculate the levy income to ensure we have a positive cash flow. Now, in an accounting tax agent term, we call that a cash flow analysis. If we're doing that in a strata scheme system, we call that preparing a 10-year plan. Now, the two most common questions I will get asked is, are my levies too high or are my levies too low? Or possibly, is my fund balance right? And if you ask me any of those three questions off the top of your hat, I am going to have a simple answer. What does your 10-year plan say? So that's the purpose of your 10-year plan. It's designed to help you make that decision about what your levies should be. I'm going to sidestep a little because if you are trying to explain this budget system to an inexperienced lot owner or a 10-year plan to an inexperienced lot owner, the easiest way of doing it may be by using a reserve fund. Now, Nikki, we seem to have lost the background again. Have I got a slide here?
You do. We can see the graph.
I could, thank you. It's just being a little slow. This is a graph taken out of one of my sample reports. And to give you an idea, most service providers who specialise in 10-year plan style reports will give you something pretty similar. So over on the far left-hand axis, we have fund amounts. Along the bottom, we have years. If you look up about halfway up the left-hand side, you may be able to see a little red cross. And I'm missing having my little laser pointer to be able to show you where I'm looking at. The red cross is our starting balance. So at the start of this report, we have a starting balance that's $150,000. The red expenditure, the dark red bars, are our expense for the year. So in this year, we spent very little money. The black line is our levy. So for this year, our levy amount was much more than our expenditure. And at the end of the year, that blue bar is what we have left in our balance. And when you look at this chart, what it tells you is that for the first 4 years, we are collecting levies that are higher than our outgoings for the expenditure in that budget. And as a result, that blue bar of the fund balance goes up each year. But when we hit the 5th year, we hit a really big expense, and I guarantee that will have been your external painting. And in that year, the levies were much lower than the expense. If we were just paying as we went along, the levies in that year would have been a special levy, a very big special levy. Instead of which, what we can do is we can use part of that built up reserve in the fund to make up the difference between the black levy line and the actual amount of our expense. So we've what we called smooth the expense out over a number of years. And for the subsequent years, we're going to have the same pattern happening, but in lower amounts. We've got some years where our levies are a little higher than the expenses, and some years where the levies are a little lower than the expenses. And what throws a lot of people, depending on where you slice through the timeline, is at the end, we still have a balance. And that's because these expenses don't stop happening. 5 years from now, when we do the next update of this report, at the end of that time period will be another massive big red line for that painting coming again. So we need to make sure that we still have some ongoing balance carrying forward towards those future expenses. Now, that's probably as good a summary as you're going to ever be able to get of the whole concept of what we call accruing accounting, or the fact that we are smoothing the expenses as much as we can over a number of years. I'm not going to try and tell you how we actually do that levy calculation. Internally, we have some pretty sophisticated cash flow software that does that. If you're doing that at a committee level, you will probably use a very simple spreadsheet to do this calculation, and you take that levy calculation back to that budget meeting, and that is what you ask the lot owners to approve to be paid. And there's our summary. A 10-year plan is designed to identify long-term major periodical capital expenditure. It's to estimate the timing of the expenditure. It's to estimate the quantum of the expenditure, and it's to recommend contributions which effectively and reliably fund the long-term maintenance liabilities. And you'll notice, touch wood, we've still got a slide up there, that you are looking at a bracket that says annually. The concept behind this is an expectation that we're going to use that smooth style accruing fund, but the Act doesn't actually say you have to. Theoretically, one of the weaknesses in this Act is that if you want to, you can get that mandatory 10-year plan, and as long as you've got it and had it approved by the Owners Corporation, you can then file it permanently in your drawer and pretend it never existed, at least until you have to update it 5 years from now. Don't recommend it, but it would be legal. Equally, there will be occasions when, based on the circumstances, it would be appropriate for you to use a mix of that accruing reserve fund method and either some form of special levy, particularly if you want to do a major improvement, or possibly some form of loan finance. If you are one of those schemes which are only just adopting a reserve fund and you have a major big expense like painting coming up in the first 2 or 3 years, there simply won't be enough time for this accruing system to smooth out that expense so that you don't hit something like a special levy, or that you might want to look at something like one of the painting contracts that lets you have a finance option. So you can still control everything. And it's equally important for me to tell you that even once you've taken this 10-year plan to the owners and had it approved, as you need to do, you are not bound in any shape or form to pay any attention to it. So you can still change timing of items, you can still use a completely different set of levies, you can still fund things in a completely different way. This is just a guide. Quick shout out, Nikki has this link. Most of you are probably familiar with Landgate's written or PDF guide. They also have an absolutely brilliant 8-minute video that talks in simple English all about this principle and concept. If you are looking at lot owners or committee members who you want to bring up to speed, that's a great thing to send them. Send them a link, let them read through that. Then when they come to talk to you, they're going to be dealing with a known base information, and you can start discussing just the specifics that you need to deal with. Other quick digression, a 10-year plan is not an asset register, it's not a current condition report, it's not a structural engineer's report, it's not a detailed maintenance schedule, and it's not a specification of works. All of those things are facility management reports. They are all very valuable. For many of them, I would be happy to give you a quote if they're appropriate, but they are not a prerequisite for being able to put together a 10-year plan. If you have some of them, like an asset register, or you've had something like a structural engineer's report, by all means, tell us about them, but you don't have to have them to be able to put together a completely compliant, completely appropriate 10-year plan. Okay. Moving somewhat from the pure theory into the practical. Lots of you asked me, what does my 10-year plan need to include? And particularly if you're trying to do it yourself, what do I have to do to make this 10-year plan? So this is the only relevant section of the Act. And basically what it says is, in the first part, you need to identify the anticipated expenditure items that are going to occur during the 10-year plan period. Don't get thrown by that reference to personal property of the strata company. That's just the technical term for things like pool furniture, which aren't actually attached to the land or the building. Once we've identified which of the assets are going to need that maintenance, the second part of the process is that we have to estimate what the cost for that work is going to be. To go past this point, we need to step down into the regulation, and we're going into section 77 of the regulation. Important, regulation 77 does not change the purpose of the plan. You need to be really careful when you're reading this section, because some of the wording, as I think Nikki will attest personally, is very confusing. And also be careful reading Landgate's guide. They are somewhat unuser-friendly at that one point. So you need to be careful. Make sure you really read it well so that you know which parts of this are mandatory and you absolutely must deal with, which parts of this are discretionary, and you can choose whether or not you take any notice of it. Section 77.1, which I'm going to flick through very quickly here, lists the 8 items that you must look at. So these are the 8 items that if you commission a consultant, they must have for a complete report, or if you're doing it yourself, you must be able to tick off to have a complete report. First 4, pretty administrative. You can read those for yourself. Except that I'm going to note that you need to have the name of the persons who prepared the plan, and if it's consultant, the qualification. Some of you have asked me, does this report need to be done by a specialist consultant? As you can see from the section there, the answer is obviously no. But what you do need to be aware is you have a duty of care. So you need to be sure that if you're doing this yourself, that you have the appropriate qualification or experience internally inside the committee to manage the infrastructure that's part of your scheme. If it's a very simple survey strata or some of the survey plans where all of the buildings are part of private lots and all you have to manage is a little bit of driveway and a fence, pretty much any committee can manage that as long as they're prepared to put the time in. If it's something more complex, which has really big painting, for example, you may only have a small number of line items in the plan, but it might still be smart to get a professional expert, or at least to get, say, some trade advice about those big ticket items. Once we move into the really big developments, then I'm afraid I think you really should have an expert. Duty of care is probably going to make that appropriate. Oh, silly sounding comment. Period covered by the plan. You would not believe how many internally developed plans I see which do not have a date for creation and simply say year 1, year 2, year 3, year 4. So when you pull them out in the plan 4 or 5 years later, you have absolutely no idea what period they applied to. So please do put some dates on it, and ideally date the years as well as just saying number 1, 2, 3, and 4. The last 4 things are your critical things. They're your covered list, which we'll talk about later, the condition report, and then the disclosure of the methodology and assumptions. That is reasonably important. This document does not need to be War and Peace in detail, but you do need to have enough information that you can make a reasonable business assessment about what the contents are. So, for example, you should know whether there are major inclusions or exclusions. My report should tell you, for example, that I haven't included allowances for any structural defects, that I'm not making an assessment about whether some things might be upgraded because they will give you a faster speed, or because the regulations might go out of date in 4 years. Because that becomes relevant when you pick it up in 4 years and some of those issues may have happened. It should also tell you all the minor variables that are critical to the calculation. So, for example, you really do want to know what inflation rate I'm using when I'm calculating my future costs. Finally, tucked down at the bottom is the last half of that cash flow analysis. Once we've gone through the process of identifying what the items are, what the expenses are, and when they're going to happen, you need to prepare your 10-year plan with a funding analysis to actually recommend what the levies should be. And if you get that plan prepared by an external consultant, you should expect to have those sets of calculations clearly set out so that you can just pick the plan up and start implementing it. Before I stop and actually show you an example from my report of some of those things, there are 2 things that the definitions are a little more detailed for. The first is section 77.2, which is your covered items. And that is frankly an incredibly long-winded way of saying the same things. You just need to identify those things in the legislation which you have reason to believe are going to need maintenance in the next 10-year period, assuming you're doing a 10-year plan. And once you've done that, you're going to do an analysis of where you're going for the maintenance. Now, section 77.3 contains an absolutely massive list of items that may be included in the plan. But to quote Landgate, to help strata companies start, there is a list in the legislation or the regulation of items that are often part of common property. This gives you a starting point for discussions and clarification on what items are included in your scheme and whether they are likely to need repair or replacement in the next 10 years. if your strata scheme has items that aren't included in that list, you can add them. Or in contrast, you might have very few items from the list, particularly if yours is a survey strata scheme with limited common property. So if you are doing this list for yourself, pick up Regulation 77.3 by all means. Pick up any other survey plan documentation or 10-year plan documentation you already have. Ideally, get together someone who knows a bit about the history of your building or your scheme. With a bit of luck, find someone who has a little bit of maintenance or building experience. Then start at the top and ask the basic question, does my scheme have a car stacker? No. Put a line through the item and move on. You do not need to document the fact that your scheme does not have a car stacker as part of your plan. Does my scheme have foundations? Yes, but will that need to be done in the next 10 years? No. Put a line through the item, move on. Does my scheme have footpaths and paving? Yes, it definitely does. Second question, do they need maintenance and repair in the next 10 years? Well, that's going to depend on what you see and the age of the building. So if you're looking at this building and it's brand new and got beautiful paving, there is nothing there now that needs repair, and normal fair wear and tear wouldn't require maintenance, then there's nothing you need to do to put in your plan. If you are looking at a 15-year-old building and you see a little bit of cracking, you might say, nothing now, a little bit in my plan for some minor pothole maintenance in 10 years time. Yeah, that's fair. If you walk around and go, oh, whoa, look at that. Big cracks off the corner, big joints that are tripping hazards. Yes, definitely need to do something about that straight away. You put an allowance for that in your 10-year plan, and you put your allowance in your current budget, and then you assess whether you also might need some repeating costs in future years because you may have a trend of maintenance that's going to be ongoing. That's basically the process at its simplest. Condition report, if you've just gone through the process I've talked about, you have almost all the things you're going to need to finish this condition report, because all you're doing now, you identify the items, is you're working out what work needs to be done on those items. And it's going to be a simple thing. You've already worked out that you need to include the paving as a covered item because it's going to need pothole maintenance. The two go together. This term condition report is a bit misleading, unfortunately, and I say that because when you're looking at that assessment, you aren't just looking at what you see on the site today, which is what we normally think about when we talk about a current condition report. You also have to think about what will happen fair wear and tear over the next 10 years. And that's why I'm saying that the person preparing the plan may need to have a degree of maintenance knowledge and expertise, because they're going to have to know enough to know what things could be impacting that infrastructure in the future. Two other minor points. Covered items can be listed separately or grouped. Really nice. You do not want to list 100 light fittings as individual line items. So when we're assessing the condition of those light fittings, we're probably going to look at them in the basement as a group, and we're going to say, look, they're all in pretty good condition, but I may need to replace just a small number in the next couple of years. And that is what goes in this report. In 5 years' time, when we come back and we update this report, we do that same exercise, and we probably still aren't replacing all of them unless you're going to energy saving technology. But because they're older, it might be a higher percentage of those light fittings that we put into that next report. And for the same reason, I'm saying a condition report can relate to a single covered item or to a group of covered items. So you could have one report come from a structural engineer, which is the condition report for your wall, and you could have a completely separate report coming from Leary Partners, which is the condition report for everything else in the scheme. And it's the combine of those two reports together which become the official condition report. And it's the combination of those two sets of funding recommendations together which ultimately form your total 10-year plan. Now, I know our time is going, so let's have a very quick look at this or we'll be totally out. This is an example of the expenditure sheet from one of our sample reports. And this is a very simple, small report, so I can fit the whole page on your screen. What you can see down the left-hand side is a simple list of items. This is effectively our list of covered items and what that identified maintenance requirement is. So the first item says we're going to maintain the glazed aluminium balustrade. Then we're maintaining the window hardware, and at the third line we're painting the building facade. So we're not talking War and Peace. You only need the same level of common sense description that you would use if you were putting together your annual budget for approval. Then the next part of the report that we really need to look at now is on the right-hand side, and that is the column year after year, what expenses are going to happen in that year, and at the time we do it in that year, what is that expense going to occur? And we total each of those columns down, and at the bottom in the column, sorry, in the bottom row where we see total, those are the total amounts that I transferred over to the chart we looked at earlier. So that's the expenditure component of our cash flow analysis. And this is the other part that you would see when you're looking at our report. This is the funding component that we said we needed so that you could go to the AGM with a levy recommendation. Up the top section, it has lots of those pieces of information that you need to know about as a variable. It'll tell you the starting date is 1st of February 2020, that the starting balance at that date was $150,000. It's telling me that we believe you are a GST registered entity, so I need to put GST credits back into the system. It's telling you that we're planning on having an annual increase in maintenance cost over the full 10 years of 4%. And yes, I know we aren't at 4% now, but I guarantee that construction style costs are not going to stay at their current level for very long once the industry starts picking up. It's telling me that I'm hoping that you have some of this money in an investment fund and that it's going to be earning about 2% of interest in each year. And based on that, down the bottom, it is making a funding recommendation. For each year, it is saying, we think you should be contributing a total amount of, and in the first year it was $26,176. In that first year, we're expecting you to have expenditure off that expenditure sheet of $3,903. Because we have a lot of accountants who like to plug things through their calculators, we're telling you that we're going to add in $2,256 of interest, which ends up with that fund balance we looked at in our chart of $174,259. So this circles us all the way back to where we started with that basic question: is my levy high enough? Is my levy too high or too low? Well, the answer is, does your levy match that funding plan? Is my balance too high or too low? Well, the answer is, does your balance match the funding plan? But with one important caveat. Think about that chart we were looking at. It had a really major expenditure peak when we did the painting. So what was an appropriate balance the year before the painting was much higher than what was an appropriate balance the year after we did the painting. So if you're a committee looking at that balance, you need to be mindful of checking whether you have in fact done the painting. Because if you defer the painting for 1 year, then you should still have all of that painting money sitting in the balance at the end of the year. Now, very quickly, the complicated thing that catches people, and I'm flagging big time because I'm sorry, Landgate, but you got it wrong. Section 77.6 lists a whole lot of discretionary things that the legislators would like you to think about, and if you think it's appropriate, include. And I've put it out here because the critical thing is it must include such of the following information. Finish at that point and you're sure it's all mandatory. But you keep reading and it says, as the Strata company considers appropriate. having regard to the design, age and overall condition of the strata scheme. Unfortunately, Landgate, when they have sort of summarised this section, appears to have left out that as the strata considers appropriately comment. So be mindful of that when we look at these things. Some of these will occasionally have application, some of them will be completely irrelevant for most things. Dates of installation, construction, acquisition. For things that are cyclical like painting or equipment, if you know it, great. If you can, keep track of it from now on in. For most of the things, who cares how old your wall is? It makes no difference. Present condition or operating state, most things not really relevant. Date on which an inspection was taken, who cares normally. Details of maintenance, repair, renewal or replacement that's anticipated to be required. This is really an extra level of information on what your condition report has already said you need to keep. And so if you have expert reports, if you have gone out and got quotes, definitely keep them. But you don't need to go get extra information just for the sake of it. My one disagreement with the legislators: the date or dates on which it is estimated that maintenance, repair, renewal or replacement is likely to be required. I don't see how you can do a proper cash flow analysis if you haven't first worked out when you think the work is going to happen, because costs are time specific and we need to allow for inflation, and because inconsistent with G down the bottom, some of these things will recycle. In terms of the details of the estimated cost of maintenance, it is reasonable to ask for enough information if it's coming from a consultant to give you a little bit of a guide about what they're doing. So if I jump very quickly back to my table, you will see that we have included a rate and a quantity for most items to give you a guide to what we're dealing with. And if we're doing a progressive allowance, for example, we're replacing partially the lights, we'll tell you that it's approximately 10%. But please don't get so anal that you try and divide the exact number of lights and then complain if 10% isn't a full round number. We're going to average that. The other additional information that we're going to tell you is we're going to put in a little bit of a condition report, and if we know when something was installed, we will tell you that, and we're going to give you a really simple condition assessment. But this is really just, is it brand new and in really good condition? It's good. If it's really at its end of cycle life or it's battered up, we're going to call it bad or fit. And if it's sitting at about where you would expect to be, fair wear and tear during the normal life of the item, we're going to call it fair. There is no need to go into war and peace here either.
Kaylene,
okay.
Let's use the 10-minute mark as a time call.
Thank you. Thank you, because that is brilliant timing. I am about to get to the last closing things. How's that? Click back here. For you, if you are ordering one of these plans, I will actually stop, and somebody did ask me, what is your 10-year plan deadline? For this, you have to have the plan approved by the body corporate, or in your case, the company, at the AGM that happens first after, oh, sorry, my things have just jumped out of here. First after May 2020. So effectively, there is no absolute deadline, but you have to have it approved by the time you have the first AGM that occurs after May 2021. So some people may need to have it approved on May 2021, and some people may have quite a bit of time after that, which is a good thing. Do not leave ordering your plan if you're going to get it from a consultant until the end of that period or just on, because we are all going to be loving your work, but we aren't actually going to be able to cover everybody if you leave it to a rush. Equally, if you already have a plan, and some people have had one for a long period, you don't need to do anything more as long as it was compliant. So go back to those things in section 77(1) of the regulation, look at your document, tick off A to H, and if it qualifies under A to H, you are already fully compliant. You don't need to do anything more. if you are ordering a 10-year plan, make sure that you don't just order it by telling us to please do a 10-year plan and sending us the regulations as your order, because there are all those discretionary things in there. You may not get what you expect. You should expect that we give you everything that is mandatory, but there may be other things in that discretionary area that you want to understand in what detail we're giving you, and that you want to be able to understand whether we're going to give you extra information that's relevant to you. And similarly, if you are a strata manager and familiar with these things, I suggest doing two things. One, provide a sample copy of the report with the quote so the committee can see what they're going to get in these discretionary areas. We're happy to do that. And by the way, the tables that I have shown you today won't be in the final slideshow that Nikki gets, just because there's some copyright issues with doing that. But if you want to have a copy of those, please just ask us for a sample and we will send you the whole document. The second thing you need to be aware of is that if you are going to ask for something that is not standard or is beyond that general discretionary range, please tell the consultant when you're ordering it. That way we know we can tell you exactly what the cost is going to be and you will get what you wanted. Takeaway points. It's a budget document. It's intended to assist the company with its long-term maintenance expenses. It does not change the scheme's maintenance responsibility or replace the annual budget and expenditure approval process. Now, I will mention this. It does not, because it's in the 10-year plan and you would like the work to be done, does not mean you can circumvent the normal budget and committee approval processes, because we see that one tried quite a bit too. You still have to get the full approvals. It should include a costed list of the work expenses for which the strata company is responsible. Extra point here, be very careful if you have a strata company which has been surveyed with the wall boundary going to the external face of the lot. There are a lot of those, we're seeing them a lot. Technically, that means that all of the painting on the external walls of the lots are not part of the common property responsibility. That also technically means that the strata company should not probably be raising funds for that, and they should not probably be paying for that out of the reserve fund, which is quite a problem if you have sections of wall which are also common property lobbies, where technically if we did the report the way the survey plan is drawn up, we would include only those sections of lobby, and you would have to privately fund from somewhere else all of the lot walls. Now, we are going to come back to most of the strata companies that are in that boat and ask for a specific instruction, but we are flagging it big time because it is an issue in the eastern states, and there have been quite a few occasions when someone has either disputed your ability to collect the money and required it to be paid back, even if it wasn't the person who actually put it in there in the first place, or alternatively, someone has come up with a dispute and the tribunals have ruled that despite the fact that the money is sitting there in the fund, you are not authorized to pay it out. So you've got lot owners who have paid those levies all the way through 10 years towards that painting and then have to go and find privately the money all over again. So be mindful. That is an issue I think is going to be critical to get sorted. And the only other critical takeaway here is you only need to do what's mandatory. Feel free to do anything else you want, but that is all a discretionary option. Nikki, do we have any questions you want to add on the end?
We do, Kaylene. We've actually got a few questions here, so we might just go on. I note that we're really close to the end of the time, but if people would like to stick around, feel free to do so. I've just had a quick look through the ones that were submitted, and you have covered some of them anyway, but there are a few there that are quite interesting. So we might go through a couple, and we have received a few in during the session as well, which we can possibly touch on if it doesn't go over too long. So one of them is from Valma, saying, we are a village of 200 units, which we all own. We have common areas and we are a survey strata. The COO is keen to complete our own 10-year plan by ticking the boxes required for our village, of which we have assets just over 5 million. The residents will be advised at the next AGM and all council members will be shown the full final report. We would have approximately 10 to 12 items for future expenses. Would this be acceptable to have on file as the 10-year maintenance plan and noted to be reviewed every 5 years? The company will need to have somewhere around $5,000 for this plan. If this is adequate, would a lot owner be able to challenge the plan at any time? We're happy to proceed independently, but wish to ensure we have carried out the process correctly.
Well, I think I've probably summarised what I've already said. It's going to come down to survey strata, probably reasonably simple, straightforward assets, even as you say, relatively short list of assets. Do you have some people in that committee or amongst your group of lot owners who are going to be comfortable and competent of making a broad assessment about the condition of those items and either researching or already knowing the sort of expenses that are likely to come up? Do you have some people in that committee who are going to be comfortable or competent to either do some research about the prices, or if you have something big ticket like painting or fence repair, can you look at your historic expenses and use those as a guide for what you're likely to have in the future? The fact that you did it internally is not going to be any more or less likely to lead to a successful challenge in the future. It may just mean that there's a little more room for someone to suspect or have the perception that it wasn't fully compliant. No reason at all why you can't do it. And there's equally no reason at why you can't start the process. And if at the end you aren't completely comfortable with it, you have lost nothing but a few hours of time. You are still in the position where you could come back at any time and get a consultant to help you.
Excellent. Thanks, Kaylene. Can I just ask you to jump out of your share screen too now, if that's
okay? Yes. Thank you. Good prompt.
I can see your face in full. That's perfect. Okay, another one that we had, Graham, as a proactive chairman for a 9-owner strata, which manages its own affairs without engaging the services of a strata manager, what are my minimum legal obligations regarding a 10-year maintenance plan?
Well, basically, you've told me the first critical point. You've got 9 lots. So we're going to need to go and take a look at your insurance replacement valuation, which hopefully you are updating reasonably regularly. And that will tell you whether or not you have any obligations at all. If you do have an obligation, then we're basically going back through that step. You're happy to do that simple checklist. What are my items? What is the maintenance associated with them? What will the costs be? Simple cash flow. How much do I raise to carry forward those expenses and make sure I can pay for it?
Okay, and we had a few that came in today while you were speaking. So one of them was from Tim. What percentage of the building's replacement value is often required to be reached in a building's 10-year plan?
Look, there is no relationship at all, is the answer. Despite the fact that there are a couple of states who have either played with the idea or ACT for a little while, actually I think had this idea, there will be no necessary correlation between the building valuation cost and what goes into your 10-year plan, because you could have an extensively expensive rebuilding, which is basically just big car park driveways, some external fencing, and the maintenance for those items could be pretty minimal. Equally, you could have a quite simple looking building that has really extensive, lots of timber pergola work, extensive painting, or might be quite a bit older and really reaching the end of its life. And that building, despite the fact that its rebuild cost is not particularly high, could actually have much more in the terms of the funding required. Plus also you're talking time situational. So if you have been funding this fund appropriately from day one, you may have big variations between, as I said, what's in there the year before the painting or what's in there the year after the painting. And the same thing, if you are raising levies for a fund that has been well funded, you may only have a relatively small amount per year. If you have a fund that has not been well funded over an extended period of time, and your building is starting to age to the point where you need to replace the lifts and do major roof work, your levies are going to look pretty abnormal even if we're smoothing them, because there is only so much we can do to make the money go around.
Okay, we had another one from Gail. I think this was when you were speaking about how much levies should be at this point. Are you saying that there has to be a separate reserve fund levy itemised rather than the normal levy, which can include sufficient to cover the 10-year plan expenses?
Look, the answer here is in WA, unlike a number of the other states, the legislation may not be quite as absolutely specific, but the way it's written, it's certainly talking about you having and raising a levy for the administrative expenses and raising or identifying a levy for the reserve fund expenses. So what would normally happen in all of the states where we run these sorts of systems is that you will actually have two components that are identified in the budget papers. Now, when you actually get billed with your levy notice, it may only show one amount, but at the AGM level, for example, the AGM vote will normally be for a certain levy to fund the administrative section of the budget, which will be judged off what your administrative expenses are. And the other side of the equation will be a recommendation for a certain amount of levy from the reserve fund or for the reserve fund, which will typically be referenced back against the fact that it's an amount recommended in a 10-year plan, or that it's in some way adjusted off the amount recommended in the 10-year plan. So to get your answer, yes, you probably at a committee level and an AGM paper level will work with two different levy amounts. Once it reaches the point of you having to pay an amount in cash or credit to the strata manager, that will probably be just one listed item.
Okay, excellent. Thank you. Sorry, I'm just taking down questions as I'm listening to you at the same time, Kaylene. So we've got some comments coming through too. Just the question that we addressed before about the percentage of the building's replaceable value. Tim has also asked, in addition to that question, is when is the building's replacement value required to be included in the 10-year plan, or is this a different plan that's required?
Okay, your 10-year plan, which is coming off that test of whether you are a designated strata company, all they are doing is using your insured building cost, which they are expecting you will be getting because you are supposed to be insuring the building in most cases. It's a convenient line in the sand. They wanted to have buildings of a certain size and complexity. 10 lots is a pretty good test for most things. But if you went into the central or the CBD, you could have a massive big building, one lot per floor. What they don't want is a scenario where that sort of arrangement has less than 10 lots and is not caught. So all we are doing is setting a convenient test that says you are either a certain number of lots or we assume you are a certain size of infrastructure based on what it would cost to rebuild this building. So your insurance valuation you will get for only the insurance valuation purpose, but we're just using it a different way.
Okay. We had a question from Gail. Sorry, we've done that one. Lynn, if you have a structural report or risk plan, should this be used to make the plan?
Okay. I would actually say we're going to get technical of terms. In the term of the legislation, your plan is the entire strategy that the committee puts together to manage the long-term maintenance and funding. So it does not have to be from just one source. And in fact, that might be a case, depending on how you're going to manage it, where you in fact have two sources inputting into the final plan. So if you have a structural engineer's report and you are going to need to do work in, say, 4 or 5 years' time where you need to accrue the funds towards that and you know what the cost is, by all means, tell the person doing your plan or do it yourself, put it in and start raising the funds towards that future accumulation. If instead you're sitting here today and you actually need to do that structural work off the structural plan today, it will probably be more intelligent to look at having your 10-year plan and the structural funding as a separate item. Now, you may borrow an amount of money from that reserve fund to help subsidise the structural work if you don't want to pay for it all outright or get a loan. but you are going to want to try and treat those as two exercises, if for no other reason that structural works may have overruns, that structural works may have changes, that structural works will have very specific payment deadlines, and that means it is probably better dealt with as a component in its own right inside that total package, if that makes sense.
Okay, and then this one that's just come in, and we've had this question, it's been asked for other states, not only WA, so it's something that's an issue obviously across Australia. From Gail, are we required to have a separate bank account for the 10-year plan budget, or can it be combined in the normal bank account we have with a designated amount allowed for the 10-year plan?
Look, I'm going to say I won't be 100% guaranteeing this one, but my understanding from reading the legislation in WA is that we do not need to have a separate account. There are different legislation requirements in different states, but in almost all of the states, you have to keep separate accounts, so separate paperwork. You may not have to have separate bank accounts. Now, that's an interesting question, because in most states, and not necessarily here yet, but I'm sure it'll come, you aren't allowed to transfer money between the accounts. So you cannot accumulate money for reserve fund purposes and then have a big legal dispute and pay for those administrative lawyers' costs out of the reserve fund if the state legislation says that that is not a reserve fund expense. And equally, you should be funneling things that are expenses of reserve fund non-routine type through the reserve fund budget, not through the accounts that you hold for the administrative budget. Real world, you will probably have one lot of levies come in. At some stage, there will be one lot of bills getting paid out, and somewhere in the background, the treasurer or the body corporate manager will do a reconciliation once every couple of weeks or once a month, and then they will separate the books out and work out what your totals are on the books. But to get back to the answer is, I don't believe so, but I won't promise I've got the answer right for that one.
Okay, that's great. Thank you so much. And that probably opens up a whole new topic as well. Kaylene, I know we spoke about it before we came on air, to say that maybe in the future, these are the type of questions that we can address in separate webinars. And so we would be delighted to have you back to do that. We've got lots of comments coming in on the sideline with people saying it was fantastic information and they really got some great information out of it. It was quite detailed. And I think that was where the joy was in it, because you've given us so much detail and so much information within the session. So I'd like to say thank you so much for your time today. And we really look forward to joining you again in the new year with a few more quite detailed webinars. So thank you very much. And thank you to everybody for joining us.
Okay, thank you so much.
Excellent. Thank you. Thank you. Goodbye.